which is 15% more as compared to previous year. So in 2019, your profit is 15% more, which is a very good sign. But I tell you that your customer satisfaction level is going down. In 2019, your customer satisfaction level has gone down. The product reliability has gone down. So although you made a lot of profit this year, it looked like that next year maybe your profits will be low, will be less, because your customers are not happy and your products are losing reliability. So the non-financial indicator, like the customer satisfaction, your innovation, research and development, your rejection rate, your defect rate, your product reliability, these all are non-financial indicators, and they speak about future. Financial statements only speak about present and past. So this is first thing, the main philosophy, the main idea behind that, which you should keep in mind. Like if I see my income statement profit is 1 million, it does not mean that I will make 1 million in next year. Yes, if I read and analyze my non-financial data that, oh, my customer satisfaction is going down, my product reliability is going down, then although somehow I made profit in this year, but this profit will not continue in coming years because customers are not happy. So this is main philosophy which you keep in mind. And then we say that, limitations of financial statement. Number one, problem of historical information. Because financial statements are produced at a point in time and quickly become out of date. The market conditions will change. There is often too little information in the financial statements for users to make detailed future predictions. For example, users would not necessarily know information about the entity's planned future capital expenditure. So information is there, but you don't know what type of new projects you will use next year. You will start. Maybe you don't have any good projects. Maybe you are going to make some investments which are going to impact negatively on your profit. There is no guarantee that trends in historical data will continue into the future. A change in company strategy may have occurred since the financial data was published. So your data, whichever you see, it looks very good, but it was published 6 months ago. And during last 6 months, you have made changes to your pricing strategies. You have made changes to your marketing strategy, your overall business objectives. You are changing your strategies. So what will happen? Next year, profit may go up, may go down. Similarly, a change in management. Like this financial statements, every company is depending a lot on few key personnel of management. You've got a fantastic R&D director. You've got fantastic marketing director. Your marketing director has left. Your sales manager, your sales team has left. So your team has changed. So the results which were produced by the team, that team does not exist. So it is possible that next year you may not be able to produce the same result because financial statements only show the numbers. They do not tell you that the people who were responsible for these numbers, are they still in the business or not? Then creative accounting is done. When you prepare financial statements, sometimes creative accounting was done. Creative accounting means that sometimes you play with the numbers, remaining within the law. You are not doing a crime. You are not doing, any bypassing any laws, but still some form of creative accounting could be done. Creative accounting means the numbers which you produce, probably you made some provisions, probably you transferred some of the profits to the next year, you delayed some expenditures. For example, you have to spend some money on R&D, but for the 3 months you stop everything. You say, I'm not releasing any budget. I'm not making expense on trainings. Training budget I cut down. I say next year I will allocate more. So some of the training budget I stopped. As a result, my profits, they go up. And next year, when this training budget will come in, it will hit. And the same goes with many other type of expenditures. You have to do a major repair and maintenance expenditure of your office building. You know that if you do this major repair and maintenance, it goes to income statement as repair and maintenance. It is not something which you can capitalize. It has to go to P&L, and I'm just stopping it for 6 months. I say, I'll do it next year. So profits which you will see, they look very attractive because I, held some of the expenses. And next year, when I will release those expenses, they will have a double impact next year, and then manipulated. Creative accounting, example of creative accounting include removing peaks and troughs or achieving a desired profit. So what does that mean, removing peaks and troughs? Peaks and troughs means that your data, you want your, actually what happens that in business, it is possible that, some type of these things happen, but you try to make it smooth like this. So you are transferring some of the revenue in future, you are delaying some of the revenue. So you transfer, you manage it. You don't want to show like this type of movement. So you manage so if my revenue is less, I start delaying my expenditure. And when I start delaying my expenditure, it becomes smooth. So although expenditure I should have made here, but I'm not making it just to avoid this type of, I say I will spend only according to my revenue, whatever I'm getting. So it is possible. I mean, this is within the management decision. Making provisions which are subsequently reversed post year end. So you make some unnecessary provisions and then you reverse them back. Manipulating cutoff, for example, invoicing in advance to boost revenue and profits. Bed and breakfast, selling an asset to realize a profit and repurchasing it year end. So what happens that you've got an asset which has a book value of 5 million. Market value probably is 6 million. You sell it for 6 million. You book $1 million profit. Next year, you know that it is for 6 million. You buy it back for 6 million. So 6 million cash comes in, 6 million cash goes out. But during 1 year, you show a $1 million profit. reducing apparent gearing, off balance sheet financing. This is not possible now, but it was being done with IS-17 leasing. I explained in leasing chapter, off balance sheet financing. When you sell your own asset and get it back.
IFRS 16.
Yeah, get it back on lease. So this is not possible now. Window dressing is possible. For example, paying back a loan just before the year end and then taking it out again at the beginning of the next year. So you are playing with the balance sheet liabilities. Because balance sheet is prepared on 31st December. On 31st December, you return back the loan, so I don't have any liability. Next year, on the very first day, you go to the bank and say, give me loan again. So there are some, manipulations with these things. Then effect of related parties. Related party, it is a presentation standard. Related party is any party which has a relationship with the business or with the key personnel of key management. Like your subsidiary companies, your associates, these are your related parties, or relatives of your directors, the family members of your directors. These are called related parties. So you do some transfer of resources or obligations between related parties because they are under your control, they are under your influence, and it is possible to make a request of transfer of resources for a short period between the related parties. So what are related parties? Group companies, key management personnel, and companies which key management personnel or their families have influence. So these all are kind of possible things, but unethical. So, but they are done. I mean, you make an advance to some party, you assign a contract, you get a contract, which later on can be changed. But on 31st December, the impact remains there. Then effect of related parties, IS-24 requires disclosure of material related party transaction. So first you should understand what is a related party. A related party is your subsidiary company, your associate company, or any other company on which you have influence. How do you have influence? Either you have influence because of your group relationship, or you have influence because of your directors, like the brother of your director has some other company. Your director, his family member, spouse is director in some other company. So they give favor to each other. So IS-24, it requires you to show your related party disclosures, which means that a business which a company is doing with related parties must be shown separately. For example, I ask you, Emmanuel, how much are your receivables? In your business, how much are your receivables? And you say that our receivables are $5 million. Okay, fine. I ask you, how much is the receivable to related party? And it looks like that 4 million is to receivable from related party only. So it looks like that you have been giving a lot of favors to the related parties. I mean, 4 million out of 5 million is coming only from related party. So related party, where you do transactions, those transactions are not considered transparent. Those transactions are not considered at an arm's length. It is supposed that probably there has been some influence, there has been some preferences, priorities in doing business with related parties because they are so close to you. So you have to show IS-24, it requires a disclosure of material related party transactions, that what business, what revenue you have from related parties, what receivables and payables and loans you have towards related parties. So, however, it is inherently difficult to ensure that all related party disclosures have been made. We move on. I just gave you some idea. That is all. This is some. Now, I go back to limitations of financial statement. Seasonal trading, it happens. A business may be subject to seasonal trading, and this can distort results because you prepare your financial statements at the end of your peak season. End of the peak season, your cash is huge, your inventories are very low, your receivables are less, and the picture looks very rosy. And you've got $10 million in the bank account, and you show the balance sheet. See, I've got 10 million. But this 10 million is only for a few weeks or few days because you are closing the books on the peak season. What will happen next year? If you've got $10 million cash on the balance sheet on 31st December, it does not mean that you always have this cash available throughout the year. It just was collected at the end of the year or at the end of the peak season. Next year, when you will start operations, this $10 million of cash will go away. You usually have only $500,000 cash. So the numbers which are shown on the balance sheet, they reflect only one day. They do not demonstrate your position throughout the year because of the seasonal impact. Do you understand, Emmanuel?
Yes, sir.
Okay. Then you've got asset acquisition. The timing of the purchase of non-current asset can also have a significant impact on the financial statements. Like this is what we did in interpretation also, that if you purchase an asset just before end of the reporting year, your ROCE will go down. Because when you purchase asset in November and December, it goes into the balance sheet and your asset, your capital employed, it increases, but the asset has not been used for 1 year. The asset has not given advantage to the income statement. Therefore, ROC suddenly will go down if you are purchasing asset before the end of the year. We did this topic and we did one question on that as well, I remember, interpretation, where asset was being purchased for half of the period. So asset acquisition can distort results. Then there are some examples. I think that is all. Accounting policies and limitations of ratio analysis. Accounting policies can also sometimes distort or impact on your understanding of financial statements. So an entity should disclose its accounting policies in the financial statements. especially where an accounting standard allows a choice of accounting treatment. Like you can use cost model, you can do revaluation model. If you are going on cost model, your assets generally are shown at a lower value and your return on asset ratio goes up. Your return on equity, return on asset, they look very fantastic because you did not revalue your assets. I'll give you an example. You've got an assets in your balance sheet for 100,000. This is your property. And you give it on rent for $10, and your return on asset looks like 10%. Next year, the rent is $10, and you are depreciating asset like this. So your return on asset looks like this, 11%. Next year, you again depreciate it, and in fact, the rent increases, and suddenly your return on asset looks like this. So my accounting policy is to show assets at cost model, and I have not done any revaluation in the last 3 years, and this will distort the result. So accounting policies and practices, they must be shown, and because they are going to impact or influence on your ultimate understanding of your financial statements. And where an entity has changed its accounting policy, it is required to restate its comparative figures. So if you are changing accounting policy, like before you were doing it straight line depreciation, now you come to reducing balance or vice versa, you should show the impact that it is a material change. I'm talking about material change. And I just changed the policy. And because of the policy, the numbers have changed. For example, last year return on asset was 10%. This year is return on asset is 14%. And why this has happened? Because you made some change in accounting policy. You moved from revaluation model, from cost model to fair value model, revaluation model. You moved from reducing balance depreciation to straight line depreciation or something. So you need to show the changes in accounting policy as well. Limitations of ratio analysis. The usefulness of ratio analysis is limited by distorting factors, including inflation, when comparing two previous years. So one is inflation impact, because in ratio analysis, we do not show the inflation impact. Let me tell you like this, a very simple thing. You've got the EPS, earning per share. So in 1 year, your EPS is $4. In next year, your EPS is $4.10. You say, oh, fantastic, I've got up with 10 cents. But what about inflation? Last year, you gave $4 to shareholders. This year, you are giving $4.10 to shareholder. You are giving 10 cents more, but there is inflation here, 6%. So there is a 6% inflation. So actually this $4 into 6% inflation, 24 cents is only inflation, 24 cents they have been gone for inflation. How do you interpret this picture? So inflation is one factor, which is a limitation of ratio analysis. Lack of information, lack of breakdown of information. Like, what do I mean by lack of breakdown? You said that I've got receivables of, $1 million. But out of that $1 million, maybe 800,000 is your troubled receivable. 800,000 is your long outstanding receivable. 800,000 is stuck for a long time. This is under high risk. But you don't write it down in financial statement. You just say my receivables are 1 million. You say my assets. You've got assets, You say that I've got vehicles, and the value of vehicles, I've got 10 vehicles, and the value is, I don't know, $200,000. But on inspection, I find out that out of the 10 vehicles, 4 vehicles are not working. They still have value. But they are not operational. There are some problems in them. They are broken down. They need repair. So if any car needs repair, it still has value on the balance sheet, but it is not working for the business. So only 6 vehicles are working. 4 are not working, but financial statements will not tell you, So like assets and the lack of information about assets, about liabilities or whatever. Then related party transaction, making ratios incomparable with other companies. You cannot compare with other companies, because in your company, you are showing very good picture. You say that I make a profit of, 11%, whereas the market is making profit of 9%. You are making 11% because you are doing a lot of related party transactions, which give you some kind of benefit. So you can't compare yourself with the market. Market is doing business under competitive terms. You are doing business with your friends and family. You can't compare it, So these are many, many, many limitations of ratio analysis. So this was one short chapter. It's not very, you don't have to do any calculations for that, but it's kind of a theoretical thing which may come.
The liability